Ladies and gentlemen, in today's video, I will introduce you to a financial modeling exercise with the objective of determining the intrinsic value of Tesla motor. For a bit of background, it is not the first time that I value Tesla. The first time happened in 2018, and I was one of the few analysts who truly believed that Tesla was significantly undervalued. I then redo this exercise in 2021 after the split, and I found that Tesla was overvalued by about $200. I've just decided to review the intrinsic value of the company uh, based upon my updated outlook for the industry and additional information that I've been able to get for the company. For those of you not familiar with my work, welcome to the Analyst. So for this modeling exercise, we will use the discount cash flow valuation model. It is not my favorite. I have my own that I built, but I feel pretty confident using any valuation model. And it is important to also say that when you use the discount cash flow valuation method, there are really two types of cash flow that you can use to derive the value of a company. The first one is the free cash flow to the firm, which is the cash flow available to all provider of capital. And when you use the free cash flow to firm, the discount rate is the weighted average cost of capital, which helps you to determine the enterprise value that you will then adjust with the market value of debt and the value of cash and cash equivalent to determine the market value of equity. Or you can use a second type of cash flow, which is the cash flow to the free cash flow to equity, which represents the cash flow available to equity holder, discounted using the cost of equity to determine directly the market value of equity. For this exercise, we will use the free cash flow to firm. First of all, it is important to present the model that I built. As you can see, it's a very dynamic model that helps you to flow nicely to different tabs of your worksheet. It requires basic level of Excel coding, okay? As you can see. So because we are using the free cash flow to firm, we have our key variable that we need to forecast. The first one is the free cash flow to firm. The second one is the weighted average cost of capital for the first period, I mean from now to 2030, and for the second period, which I mean from 2030 to the foreseeable future, and the growth rate, which is the foreseeable, the long-term or the long-term growth rate. So I will forecast the key variable, the main one, which is the free cash flow to firm under three scenarios. This is going to be my key variable. The first scenario is under the best case scenario. Under the best case scenario, the second is under the base case scenario, and the last one is under the best case scenario. To determine the free cash flow to firm, I decided to use a formula that I like a lot, which means determining it from the EBIT, earning before interest and tax. Free cash flow to firm is equal to earning before interest and tax, multiplied by 1 minus tax rate, plus the adjustment for non-cash items such as depreciation and amortization, minus the fixed capital investment, minus the working capital investment. To determine the EBIT, what we need is to forecast the income statement till 2030 on the best case scenario. So let's go. So under the best case scenario, I use two key variables. One, the production rate, and two, the average revenue per car. So I made the assumption that one, the production rate is going to be about 45% per year. And I got that rate using the 2018 quantity produced, and my forecast for the 2022 quantity produced, which is actually an estimate. And I also made the assumption that the quantity of car produced by Tesla is equal to the quantity of car sold by Tesla, because I've always believed that the real limitation for Tesla is the ability to mass produce car, because the demand is real, but mass produce car that are cost effective. So for the first variable, I will assume that 45% growth rate is going to be the one that gives us the quantity that they will produce per year to about 22 million in 2030. And the second very important variable, which is the average revenue per car, I made the assumption that that revenue per car will decrease per year to about 35,000 in 2030, okay, using publicly available data regarding the average car price. And I picked 35,000 to be the one that, that is more realistic. You can do the same and pick a different number. I picked 35,000. So using those two variables, I can derive the first line of the revenue in the income statement, which is this one, just by multiplying the average price per car by the quantity produced. This is the first line. And the first line tells us that in 2030, Tesla will be generating about 775 billion in car revenue. Now, for the second line of the revenue statement, which is the automotive regulatory credit, I made the assumption that this revenue line cannot be a source of revenue that the company can rely on, because it is highly likely that as we move into the future, and I made a specific assumption that by 2028, the revenue from the automotive regulatory credit will be zero, as the remaining car manufacturers align themselves with the demand of the regulator. So from 2030 and 28, the revenue from this line of the revenue generated from this second line will be zero. Now, for the third line, which is automotive leasing, I made the assumption that the automotive leasing revenue will be growing at a rate of about 37% per year, using 2019 and 2021 quantity to derive the annual growth rate. And using that, we can have, we have the value of the automotive leasing revenue till 2030. Now, for the fourth line, which is the energy generation and storage, I made the assumption that it will grow at a rate of about 35% per year. And we can see that we have been able to generate this line to 2030. Again, using 2019 and 2021 quantity to derive the annual growth rate. Some of you might say, okay, maybe the rate is too high. I will say, I don't believe so, because in a new market, exceptional growth rate are achievable. And we know that the battery electric vehicle market is still a new market that has not shown what it is capable of in terms of revenue generation. Now, for the last line, which is service and other, I use the same approach and determine a rate of about 31% per year. And this is what I've been able to get till 2030, meaning that this line will produce about 42 billion in revenue in 2030. And making the addition of all those lines, this is the revenue that the company will be able to generate in 2030, which is going to be about 887 billion, which is an impressive amount, which is a very impressive amount. That's the reason why this perfectly fits the best case scenario. Now, when we have forecasted the revenue line to 2030, the remaining line are just easy, because the remaining line will be represented as a percentage of the total revenue. And this is exactly what you get. This is the income statement that has been produced under the best case scenario. But it is important to state that when you use this approach, you always need to go back to the income statement and investigate if there are some line of the income statement that you do not expect to continue in the future. For instance, if on the income statement you have revenue from discontinued operation, you don't want to carry that into the future, so you will need to make an adjustment for that. In this case, we do not have, so it's actually good. So now, using this forecasted income statement for the next 9 years, I can find my EBIT, which is line 32. And using this EBIT, I then have the one important element of the free cash flow to firm. Now, if I go back and I go to free cash flow to firm under the best case scenario, I have my EBIT, which has already been filled. It's linked to my income statement. Now, I made the assumption that the tax rate will be about 11% from 2022 to 2030. Okay, and for the depreciation, which is also a very important and key variable, I made the assumption that the depreciation will grow at about 8% for any 22% growth in property, plant, and equipment. And this is my depreciation line that has been produced. Now, for the fixed capital investment, I made the assumption that the fixed capital investment will actually grow as a percentage of revenue. Why? Because the company usually invests in fixed capital as a function of what they expect to produce. So if they expect the production rate to grow at about 50% or the demand to be about 50% higher than the current year, what they will do is to invest in the capital, machineries, and everything to get themselves ready to meet that demand. So I represented this as a percentage of total revenue, and this is what we've been able to derive. For working capital investment, this was one of the trickiest one because you will notice that for this exercise, it is actually a positive. It actually has a positive impact on the free cash flow to firm for a simple reason that when you study Tesla balance sheet, you will notice that they retain a significant proportion of the supplier revenue. So they will not pay immediately, and it's a very smart approach because it means that they can actually use that the supplier money, obviously within the payment term, to, let's say, invest in inventories. You know, there's no indicator which shows that the company is having a cash issue. They have a very clean and healthy balance sheet. So using that adjustment, I was able to forecast the working capital investment, and this is what we get for the free cash flow to firm under the best case scenario. It is important to state that I will not have any issue if an analyst made, for instance, an adjustment to the working capital investment to make sure that it represents, to make sure that it has a negative impact on the free cash flow to firm. I will accept it. It will make sense. In this case, I did not do that. Now, once this is done, no, I think it is also very important to state that despite doing that, despite the positive adjustment that the working capital investment has, it is important to state that the actual formula, in the actual formula to free cash flow to firm, the working capital investment is a reduction. It's earning before interest and tax multiplied by 1 minus tax rate plus non-cash items such as depreciation and amortization minus the fixed capital investment minus the working capital investment. The working capital investment have a minus sign here because it means a positive adjustment. A positive adjustment because they retain a significant proportion of suppliers' money. They use that money, I suppose, which turned out to be good. And it is actually a very good strategy. It's a very good strategy instead of, you know, requiring money from the bank, which will require paying interest. I think it's a good strategy. So we have forecasted the important variables under the best case scenario. We're going to do the same thing under the base case scenario. And here is the revenue forecast under the best case scenario. Now, The only variable that I will change is the first line of the income statement, which means automotive sale. The remaining line on the remaining assumption that I used for the remaining line of the revenue will remain the same. So it means that under the base case assumption, I made the assumption that under the base case scenario, I made the assumption that the production will equal about 21% per year to 2030. And to determine that production, I connected the quantity produced in 2021 with my estimate for the 2022 quantity and say, okay, this is a reflection of the reality currently at the company level. And we're going to assume that that growth rate will continue into the future. And using that, it tells us that in 2030, Tesla will be in the position to produce about 5 million cars. Now, using the same assumption for the average revenue per car, we multiply under the base case scenario, we can get the first line of the revenue, which tells us that Tesla will be in the position to generate about 184 billion in 2030. And the remaining assumptions are the same, so we can derive the remaining line of the income statement. This is the income statement for the next 9 years under the base case scenario. And this is our EBIT that we will use in our forecast of the free cash flow to the firm under the best case scenario. The other assumption will still remain the same. So here is our forecast of the free cash flow to the firm under the best case scenario. So we are going to go back and do the same under the worst case scenario. And under the worst case scenario, I said, okay, look, I used the International Energy Agency reports about the battery electric vehicle market. And I made the assumption that, okay, let's suppose that around 2030, we have about 105 million cars produced, right? And that Tesla has about 4% market share. It means that Tesla will produce about 4,962,000 cars, okay? And I connected that that production level to my estimate of 2020 to determine the rate at which it needs to grow to reach a 4,962 unit. The assumption about the average revenue per car is going to be the same. So it means that we have our first line of the income statement under the worst case scenario, which is this one. The remaining assumptions are unchanged. So this is the key line, the line that we change. That's the key. So this is the income statement forecast under the worst case scenario. So using the same approach, we can go back. We will need the other variable, which is the free cash flow to the firm forecast under the worst case scenario. And this is exactly what you have. So having forecasted our free cash flow to firm under the best case, under the base case, and under the worst case scenario, what else do we need? We need the remaining key variables, which means the weighted average cost of capital for the first period, which means from 2022 to 2030, and the weighted average cost of capital for the second period, which means from 2030 to the foreseeable future. And we also need the long-term growth rate. Now, it is important to say that contrary to what other analysts do, which means to determine the ending value of the company, let's say around 2030, if the analyst is using my same investment horizon, what they will usually do is that they will determine a multiple of the enterprise value, such as, let's say, enterprise value divided by EBITDA. And then they will use the forecast of EBITDA in 2030, multiply by the multiple and say, okay, this is going to be the enterprise value in 2030. I do not use that approach. And the reason why I do not use that approach is because if you use that approach, it means that if Tesla is overvalued in 2022, and you use the 2022 multiple, then you will transfer that overvaluation in 2030. That's the reason why I decided to choose the difficult way, which means determining what I believe is the long-term growth rate for the industry and the weighted average cost of capital for that period. So let's go. Now we will go to our estimation of the weighted average cost of capital. So first of all, I determine the debt to total capital, which is about the capital structure, the debt to total capital to be about 18%, the equity to total capital to be about 84%. And I said, okay, the cost of equity for Tesla for the period going from 2022 to 2030, I determined that cost to be about 13%. You might say, okay, how did you get that? I say, okay, the cost of equity is the compensation that an investor receives for the risk of investing in the stock of a given company. That compensation comes in, let's say, dividend and capital appreciation. It's a return that you get. It's a required return. It's your required return. So for a company like Tesla, which does not pay dividend, the only compensation that an investor gets, let's say you invested in Tesla 3 years ago and you sold this year, what was the compensation? It was the capital appreciation that you got. So I divided the share price of Tesla from 2010 to 2022, and I'd say, okay, what area of the chart is the best representation of what we may expect in the future? This is how I determine this cost of equity, which is about 13% for the first period WACC. For the cost of debt, using the balance sheet and income statement, I determined the cost of debt to be about 5.2%. It is highly likely that you might have something different because I think Tesla borrow using floating interest rate and using the formula, which is the weighted average cost of capital is equal to the cost of equity multiplied by what equity represents in terms of proportion, plus the cost of debt multiplied by the weight of debt in the capital structure multiplied by 1 minus tax rate. This is what I got for the weighted average cost of capital for the first period, which means going from 2022 to 2030. Now, for the second period, meaning that from 2030 to the foreseeable future, I said, okay, I will use the CAPM for that one. The CAPM meaning that I will determine what is the long-term growth rate, what is the long-term return of that equity market sector. And I found the long-term equity market sector return to be about 13.46% using the indices that are available out there. I think I used the one from the S&P auto industry. And then because that rate was a 10-year rate, I could only get for the period of 10 years. I said, okay, I will use the risk-free rate. I will use the 10-year treasury yield as the risk-free rate. So I got my risk-free rate. I got my total or the equity market return for that industry. I have the cost of equity that I forecasted to be, okay, it is important to say, I said I will use the CAPM to determine the cost of equity for Tesla. And you know the formula for the CAPM. So I have the total return for the industry, which is the market return. I have the 10-year treasury yield. I have the forecast for Tesla beta, which I forecast to decrease as we move into the future. And I think that is going to be comparable to the one of Toyota. The one of Toyota currently is about 0.6. So I'd say, okay, let's suppose that Tesla is going to be about 0.8. Using that, we derive the cost of equity, which is about 11.30%. Now, using the same weight of debt and equity on the capital structure, I forecast the cost of debt to be about 4.2%, right? The tax rate is obviously going to be the same. It means that we have the weighted average cost of capital for the second period to be about 9.92%. Now, what about the long-term growth rate? I use the OECD forecast for the global GDP growth for the next 50 years. And I said, okay, I will assume this is going to be the long-term growth rate because the economy, we know the world is in a serious turmoil right now with the war everywhere in the world. So I will use that growth rate as representative of what will happen in the next 50 years. Now, having forecasted the key variables, which is the WACC for the first period, the WACC for the second period, and the long-term growth rate, I can then go to the last sheet, which is the forecast of the fair market value of the company. Now, we are going to determine the fair market value of the company under three scenarios: the best case scenario, the worst case scenario, the best case scenario, the best case scenario, the base case scenario, and the worst case scenario. Now, what do we have? We have our cost for equity. We have our discount factor. For the first period, we're going to use the WACC 1 to determine the discount factor. Now, there's one thing that I want you to notice. You will notice that for the first period, I use 9.5. 9.5 because I consider to determine the value. The period 0 was the 1st of July. So we're not going to be dealing with 1 year. We're going to be dealing with half a year. So that's why I'm not going to use 1. I'm going to use 1 divided by 2 to have this. This is an adjustment that I made because technically we are talking about 8.5 year, not 9-year forecast, right? So I determined the discount factor for the remaining period. I multiplied the free cash flow to finance I multiply with the discount factor, and this is what I get. And now for the enterprise value, first of all, the last year cash flow obviously is going to be discounted to get this. And now for the enterprise value in the year 30, I'm going to multiply the last year free cash flow to finance by 1 plus the growth rate divided by the WACC in 2030 minus the growth rate. This is the enterprise value around that time. I will make an addition of all those numbers and get an enterprise value about 958 billion today. Now I will make an adjustment for the market value of debt, an adjustment for cash and cash equivalent to determine the market value of equity of about 972 billion. Now, if I divide that using weighted average stock outstanding, the basic one, I get the share price, the value for the share price of about 937. If I divide it using the diluted value, I get about 841. I will use the same approach under the base case scenario, and I will get the share price under the basic of about 516. Using the weighted average stock outstanding basic, or the share price of $463 using the weighted average stock price outstanding diluted. I will use the same approach using the worst case scenario, and I will get the share price of about $508 using the basic weighted average stock outstanding, or the value of 556 using the diluted weighted average stock outstanding. So what does that mean in conclusion? It means in conclusion that the value of Tesla is a function of what you believe the company is going to be achieving within the next 8 year or 9 year and a half, if you want. Do you believe that the company will perform in line with the best case scenario? Do you believe that the company is going to perform in line with the base case scenario? Do you believe that the company is going to perform in line with the worst case scenario? If the company will perform in line with the best case scenario, then the value of Tesla should be using weighted average stock outstanding basic the value should be about $937, or using the diluted one should be about 841, which means that the current share price of Tesla is almost the best representation, or meaning that the current value of Tesla is fairly valued. Or if you believe that the best case scenario is what is highly likely to happen, then the fair market value of Tesla should be around, using basics, $516, or using the diluted one, about $463, meaning that Tesla is grossly overvalued. Or using the worst case scenario, if you believe that this is the best representation of what is highly likely to happen, then the value of Tesla should be about $508 using basics, weighted average stock outstanding, or 456 using diluted one. So what do I believe? I actually believe that the approach that I used was to say, okay, I'm going to average them. I'm going to average the values that I get using the best case scenario, the best case scenario, and the worst case scenario. So I will average the highest point to get about 587. And I will take the lowest value that I get under the worst case scenario to be using the diluted one, 556, to say that, okay, I believe that Tesla will be fairly valued to me if the share price is within $456 and $587. So it means that with the current share price being about 874, Tesla is overvalued. As simple as that. And this is not really far from the valuation of Tesla that I did in 2021. I can still share it. It is still available on my Twitter page, meaning that the model that I'm using, which is different to the discount cash flow model, is almost right. So I hope you enjoyed the video. I hope you like the method. I will obviously enjoy your comment regarding the model. I think it is very important for us analysts to always back our decision of overvaluation, fair evaluation, undervaluation, using our forecast of future fundamentals. The first question that I always ask to my fellow analysts is, what are the expectation backing the value that you are giving to the company? Okay, so I really hope that you enjoyed the video. If that's the case, don't forget to subscribe. And yeah, if you're looking for a chief investment officer, you can contact me. If you're looking for a research analyst and you can pay what is required to get me, you can contact me. So do not forget to subscribe if you like this type of video, and see you next time.